All right, today we're going to dig into a concept that is, and I'm not exaggerating here, the absolute foundation of financial order inside any big company that runs on SAP. We're talking about posting periods. You can think of it as the system's financial clock. And trust me, you need to know how it ticks.
So let's just start with a simple question. Picture a massive global company. I'm talking thousands of transactions every single hour. How on earth do they stop their books from becoming a complete and utter disaster? Well, the answer is a really, really controlled system. And that's exactly what we're going to unpack.
So, here's our game plan. First, we'll get into why these periods are so darn important. Then, we'll look at a kind of weird thing SAP does. It has two separate clocks. After that, we'll build the system from the ground up, define the master calendar, figure out who controls access, and finally put it all together.
Okay, part one. Why should you even care about posting periods? This isn't just some random technical setting. No, this is the bedrock. It's the whole foundation of financial control and making sure the data in SAP is actually trustworthy.
The whole idea boils down to one simple, unbreakable rule. Think of each month, January, February, and so on, as a locked room. For any financial transaction to be recorded in January's books, the door to the January room has to be open. And once the accounting for January is done, that door gets locked, and it stays locked for good. This is what protects the integrity of your financial reports, period. Now, here's where things get a little more interesting. You'd think SAP would just have one big master clock for the whole company, right? Wrong. It actually runs two completely separate clocks for two very different parts of the business. And you can see that divide right here. On one side, you've got material accounting periods. This clock is for everything related to logistics. Think inventory, sales, production, the physical stuff. On the other side, you've got the financial accounting, or FI periods. This is for pure financial transactions. And the key thing to remember is they run on totally different schedules. So what's fascinating about this is the kind of pressure it creates. For that whole logistics side of the house, the system is incredibly strict. Only two periods are ever open at the same time: the current month you're in and the previous one. That's it. This puts a ton of pressure on those teams to get their work done on time. If they miss that 2-month window, too bad. They're locked out. Okay, so for the system to know which periods to open or close, it first needs, well, it needs a calendar, right? And that brings us to part 3, defining your fiscal year. This is basically the master calendar for the entire organization. In SAP speak, this master calendar is called the fiscal year variant, and its number one feature is flexibility. I mean, it doesn't care if your company's fiscal year starts on January 1st, like most companies, or if it starts on, say, October 1st. You can configure this variant to perfectly match whatever accounting calendar your organization uses. Now, you'd probably assume a fiscal year has 12 periods, right? One for each month. It seems logical. But SAP gives you a little more breathing room. The maximum number of posting periods you can actually have for the finance side in a single fiscal year is 16. So why 16? What's the deal with the extra 4? Well, you get your 12 normal posting periods for all your regular day-to-day, month-to-month business. But then, SAP gives you 4 special periods. And these are absolute lifesavers when you're closing out the year. They're meant for things like last-minute adjustments from your auditors or final tax entries, stuff that always happens after the 12 months are already technically closed. It's a genius way to keep your regular monthly reports clean. Okay, having a 16-period calendar is fantastic, but it's pretty useless if you can't control which of those periods are actually open for business. So that brings us to section 4. It's time to meet the system's official gatekeeper. And that gatekeeper is called the posting period variant. Its only job is to control access. It lets you specify exactly which periods, both the normal 12 and the special 4, are open for a specific company code. This is huge. It means you can have, say, your US company on one closing schedule and your German company on a totally different one, all managed neatly within the same system. And applying this control is a super logical 1-2-3 process. First, you define the rulebook. That's the variant itself. Second, you assign that rulebook to a specific company. And third, you just use it to open and close the periods month by month as your accounting cycle moves along. Simple as that. Now this, right here, is the most important takeaway: the separation of duties. The fiscal year variant, it defines the structure of the calendar. The posting period variant, it manages access to that calendar. And because they're independent, you get this amazing combination of a rock-solid structure and total flexibility in how you control it.
All right, we are at our final section. We've seen the calendar, we've met the gatekeeper. Now let's put it all together and see what this complete control system looks like when it's all working together. This table really just sums it all up perfectly. On one side, you have the fiscal year variant. Its function? Define the calendar. Its scope? The whole organization. On the other side, the posting period variant. Its function? Open and close the periods. Its scope? Just a single company code. One of them draws the map, the other one directs the traffic.
So what you end up with, because of this really clever design, is a system that finds the perfect balance. It gives you that rigid, airtight control that you absolutely need for accurate financial reports, but it also gives you the flexibility to manage the messy reality of different closing schedules in a big global business. And that kind of leaves us with one final thought. Now that you see how SAP builds this whole system of checks and balances, what do you think is ultimately more important for a business to succeed? Is it the flexibility to bend the rules and adapt? Or is it that airtight discipline that prevents anyone from ever stepping out of line? That's really the core tension this whole system is built to manage.
For more videos, please like, share and subscribe the channel SAP Gyan.